I think as we all know, 2018 was a difficult year for many asset classes, including Asian US dollar bonds, which recorded its first negative return since 2013. However, we expect a much better year for Asian bonds in 2019, mainly because the two main factors that dragged down the markets in 2018 have turned positive already. Firstly, the markets were concerned about the Federal Reserve rate hikes in 2018, which provided a negative sentiment for fixed income generally, which affected all the asset classes as well. However, that has almost completely reversed, with most investors anticipating a slower rate hike pace in 2019. Secondly, Chinese US dollar credits, which represents a very significant portion of the Asian markets, traded weaker in 2018 as deleveraging in China led to much tighter liquidity and raised concerns of increasing defaults in China. Again, the story is completely different now, as maintaining economic growth appears to be the priority, which means liquidity is significantly looser. Furthermore, China has aggressively cut the RRR recently that has flooded the market with liquidity that will be very positive for the Chinese credit market. We believe liquidity would remain loose in China, with monetary policy maintaining a loosening bias. This should create a very favorable environment for corporate refinancing, which should reduce default fears and, even more importantly, lead to lower funding costs for corporates. This means there is room for market yields to come down, leading to potential price gains for corporate bonds. Besides, as onshore liquidity is ample, we would expect less supply in the US dollar market to further improve supply-demand dynamics. Also, the yield to maturity of Chinese US dollar bonds tends to be high relative to other sectors, so investors can also enjoy an attractive coupon carry. Broadly speaking, within the Asian credit universe, we prefer Chinese issuers mainly because they offer the most potential for spread compression, as well as providing relatively more attractive yield carry. For example, the top-tier Chinese SOEs are yielding more than some lower-rated issuers from other Asian countries. Also, the reduced focus on deleveraging in China would provide a very good backdrop for these Chinese issuers, especially they have underperformed in 2018 due to this very same factor. More specifically, we favor the strongest of the Chinese SOEs, as they are fundamentally strong companies while still enjoying a lot of support from the government. Besides, we also prefer Chinese property developers, as their much improved funding conditions will be particularly beneficial for this sector.